If I had to choose just one asset class to invest in for long-term, steady, risk-adjusted, sensible returns, it would always be commercial property. I love investing in bricks and mortar. It quite literally has solid foundations. The returns are normally fairly predictable because it's easy to identify the rental income you're going to be getting either from a property or from a fund. And generally the capital values will rise in line with inflation. Commercial property is very sensitive though to the economic backdrop. Obviously, if the economy is expanding, if it's growing at a rapid rate, then businesses, shops, restaurants have a need for more and more space, and commercial property prices will rise to keep up with that demand. If, on the other hand, you have an economy that's either stagnant or is going backwards and in recession, then naturally the demand for space reduces. The need for commercial properties reduces, and therefore prices are likely to fall. Therefore, you've got to be very careful of the timing of entry and exit of any property investments that you make. We generally invest in property via unit trust funds, and one of the big advantages is that we can quite literally buy or sell the funds at the press of a button. And over the years, as a result, by carefully timing the entry and exit points, we've managed to add significant additional value for our clients. You do have to be very careful though, because if property funds have a large number of people withdrawing money from the funds, then they do have the ability of barring investors from withdrawing their money. It's what's called gating. They literally draw up the gates and stop you from taking your funds out. However, there are a number of early indicators that should give you a warning sign that that might happen in the future. So obviously we've just talked about the economic sensitivity of property. So if it looks like the economy is going to go backward, that's a huge warning sign. You can also look at the flow of money into and out of the funds. If the fund's having a lot of withdrawals on a regular basis, then again, it's another warning sign. You can also look at the yield on commercial property and think whether or not it's competitive, whether it's compelling against, say, investing in fixed interest, buying equities, or even just leaving your money on deposit. So if you've got a low yield, you've got funds that are seeing falls in value via withdrawals, and you've got a bad economy, then you want to get out of commercial property pretty darn quickly. If you have a look at the Sunday Times Rich List, you'll see that a number of them made their fortune from commercial property. Investing in commercial property funds may not make you rich, but it certainly could help you stay that way. If you'd like to know more information about our approach to property, then why not attend one of our events, have a look on our website, or give us a call and pop in and have a quick cup of coffee.